of the 1980s, when there was, something called pit trading or open outcry trading in India. Okay, what was open outcry trading? So typically there used to be a trading ring, so a place where all the brokers used to assemble, and the trading was conducted manually through hand signals and shouting out of orders and manual recording of orders and trades, etc. Right? So as you are probably aware, the NSE was the first exchange to have a screen-based trading platform way back in 1992. And so since 1992, all the trading of the cash market as well as the derivatives. Of course, the derivatives market started in the year 2000, right? But cash market started before that, and so the trading is now totally screen-based trading. Okay, it is fully automated screen-based trading for all kinds of equity derivatives, and it is an order-driven market. Okay, order-driven market, as in the client places an order, the order goes and sits in the order book of the exchange, and then the exchange automatically matches all the buy and sell orders, and the orders are executed. Okay, so it is an order driven market, and all exchanges have this developed a software for the F&O market to facilitate efficient and transparent trading. Okay, so who are the entities involved in the trading of futures and options? So in the equity derivatives market, we have three kinds of clearing members. So we have somebody called a trading member, and then we have someone called a clearing member, and then we have authorized persons and custodial participants. Okay, so all these are entities involved in the trading of futures and options. So a trading member is your normal broker who directly deals with the clients, who collects orders from the clients and enters them in the in his trading system, right? But the trades of the trading member are cleared and settled by the clearing member. So the clearing member is the one who is responsible for the clearing and settlement of the trades of the trading member. Now, there are three kinds of clearing members in the equity derivative segment. The first is the trading cum clearing member. Okay, so this is basically an entity. Typically, it is a broker, an entity that trades as well as clears the trades. Okay, so this would be typically a big broker. Okay, so such as say somebody like Motilal Oswal or Sher Khan. Okay, they would be trading cum clearing members, because they not only trade for their own clients, but they also clear the trades of their of the trading members who are trading with them. Okay, then there are some clearing members known as professional clearing members. So these entities, they simply clear and clear the trades. Okay, they do not trade, they do not themselves make any trades, but rather they clear the trades of the trading members who are clearing through them. So example of a professional clearing member would be a bank. So for example, HDFC Bank, okay, or Citibank, that would be a professional clearing member. And then there's a third category called a self-clearing member. So the self-clearing member is somebody who clears his own trades. Okay, he cannot clear the trades of other trading members. He can only clear his own trades. Okay, so these kind of clearing members are there in the system. Okay, now what are the timings of this segment? So as you are aware, probably the equity derivatives market trades concurrently with the cash market. Okay, so the cash market, that is the market where stocks are traded, right? The cash market or the capital market segment operates between 9:15 a.m. to 3:30 p.m. and the equity derivative segment also operates within the same time, right? So this is the now in the okay, this is for a trading member. So in a trading member, in his software, a trading member has the provision of defining the hierarchy amongst the users of the system, right? So in the software that the trading member uses for entering the trades, there is a hierarchy. So at the very top, you have somebody called a corporate manager. Then at the at the middle level, there is the branch manager, and then at the bottom level, there is somebody called the dealer. So the dealer is the person who is actually entering the trades. Okay, whenever a client places an order, okay, via the phone or whatever. Okay, the dealer is the one who is punching in the order in the system. Okay, now branch manager is above the dealer. So branch manager has the, he has a view of all the orders placed by all the clients in his branch. Okay, and corporate manager is somebody which is above the branch manager. So he has a view of the orders placed at all the branches of the entity. Okay, so the one who has the the compliance activities like KYC. Okay, so uh, whenever a new client is onboarded, okay, the trading member is responsible for completing the KYC and execution of the client broker agreement, okay, timely execution of the orders placed by the clients, collection of margins, maintaining separate client bank account for segregation of client money. So we are going to look at all these things in detail, okay, later. So this is just a list of activities which the trading member is responsible for, and ensure timely pay-in and payout of funds, issuing contract notes, resolving the client's complaints, sending periodical statement of accounts, okay, maintaining a unique client code. So what is this unique client code? So whenever a new client is onboarded, okay, he is given a unique client code, okay, and this is very important. And later we will see that this unique client code is used for monitoring the position limit of the client, okay. So whenever a new client is onboarded, all these formalities, that completing the KYC, executing the agreement between the client and the broker, okay, making sure that the client reads the risk disclosure document, and all these things are done by the trading member. And then again, he is responsible for executing the orders placed by the client, and is also responsible for risk management. Okay, as part of the risk management of the exchange, the trading member is required to collect margins from the client. Okay, so collection of adequate margins, this is also a very important function, because if adequate margins are not collected, then the trading member will be penalized by the exchange, right? And trading member is also required to separately record, okay, in different bank accounts, the money received from each client. So he's not supposed to mix the money received from different clients, right? So the money, the margins, collateral provided by each client have to be kept separately. So maintaining record of that, and ensuring timely pay-in and payout of funds. Okay. So all these are the functions of the trading member. Okay. Now we said that one of the most important functions of the trading member is to execute the orders placed by the client. So what are these orders? So basically these orders can be segregated according to time conditions and price conditions. So what do you mean by time conditions? So when you look at uh, orders in this category, okay, orders based on time conditions. So first of all, there is something called a day order. What is a day order? A day order is one which is valid, an order which is valid only for that day. Okay, so suppose I place an order for buying shares of some company. Okay, say I place an order for buying shares of, say, Reliance, and it is a day order. Now, if this order is not executed during this day, like if it's not executed by the end of today, then the order will vanish. Okay, it will expire. Basically, it will expire because it's only valid for today. Then there is something called immediate or cancel order. What is this IOC order? IOC order means it has to be executed the moment it is placed. If it is not executed the moment it is placed, then it expires. Okay, immediate or cancel. It gets cancelled if it is not executed immediately. And then there are certain orders which are categorized according to price conditions. So here we have the limit order, market order, and stop loss order. Okay, so what is a limit order? A limit order is an order which will be executed only when the price specified in the order is reached. Okay, so let's say I want to buy shares of say IT Save Limited. Okay, and let's say currently the price is say rupees 450. And now I want to buy the shares only if I want to buy, let's say, at a lower price. So let's say I place a buy order, okay, specifying a limit price of 430. Okay, so my order will be executed only when the price comes down to 430. Okay, so this is a limit order. Basically, it is a limit order is placed by a patient investor, and investor is ready to wait until his fair until the price which he considers to be the right price. Okay, he's ready to wait until the right price is reached. Okay, so that is a limit order. And what is a market order? A market order is one which will be executed at the prevailing market price. So basically, you can say that the market order is for an impatient investor, one somebody who's not ready to wait. Okay, or let's say it is a very fast-moving market, and the investor is worried that if he waits for some time, then his price may never be reached, right? So in a fast-moving market, if you place a limit order, then there are high chances that your price will never be reached. So in a fast-moving market, investors would normally prefer to place a market order. So market order is executed at whatever is the prevailing market price. And what is a stop loss order? So in a stop loss order, the objective is to minimize your losses. Okay. So let's say I have bought a stock, any stock, say at 100 rupees. Okay. And then I see that it is going down. Okay. Now some unfavorable news has come or about the stock, or let's say the market as a whole is going down, right? So my stock, the stock which I bought at 100, now starts trading at 99, 98, and it is gradually going lower and lower. So let's say I place a stop loss at say 94. Okay. So that means that the moment the 94 price is reached, my I place a stop loss sell order at 94. Okay. So the moment this price is reached, my order to sell those shares will be executed, right? Because I am not comfortable holding the stock if the price is declining substantially, right? So I keep a stop loss sell order. Okay. So the aim here is to minimize the loss. Okay. So these are the different types of orders. Okay. So before we go ahead, let's have a quick Q&A just to ensure that you have understood, okay, what we have discussed so far. So first question is, what does a limit order in derivatives trading specify? And these are the options: the exact price at which the order will be executed, the maximum or minimum price at which the order can be executed, the time frame within which the order must be executed, and the volume of contracts to be traded. Okay, so which is the correct option here? You can mention in the chat. Okay, the correct answer is the limit order specifies the exact price at which the order will be executed. Remember, when I am placing a limit order, okay, okay, I am actually specifying the price at which it will be executed, right? So that's the correct answer. Okay, let's look at one more. What does a stop order or stop loss order do in derivatives trading? It executes an order when the market price reaches a certain level. It limits the amount of profit that can be realized on a trade. It guarantees execution of the order at a fixed price. It cancels all pending orders if a certain price level is reached. What is the correct answer? Okay, so the correct answer is it executes an order when the market price reaches a certain level. So as I said, suppose I have bought a stock at 100 and I keep a stop loss sell order at 94. Then the order will be executed the moment the price reaches 94. Okay, so it executes an order when the market price reaches a certain level. Okay, so that's our first module about the trading mechanism. Now let's move on to the next. I hope my screen is visible. Okay, so 1 minute, I'll just share again. Yeah. Yeah, I hope the screen is visible. Okay, so when it comes to matching of orders, okay, uh, the derivatives exchanges, okay, they provide a platform for automatically matching orders on a price time priority basis. What does this price time priority mean? So orders are first time stamped and then immediately processed for potential match. Okay, and if the order cannot be matched, then it is stored in different electronic order books. And what do you mean by this price time priority? So basically it means that orders are stored in a sequence such that the orders with the best price will be matched first. Okay, and if there are more than one orders with the same price, then within those orders the exchange will consider the order which has been entered first, right? So basically the best price, what do you mean by best price? Best price means a buy order with the highest buying price, bid price, and a sell order with the lowest ask price. Okay, they are considered the best orders. Okay, so in the order book, so let's say there are various buy orders. Okay, the first buy order is at 100 rupees, the next is at 100.50, third is at 100, 101, fourth is at 101.50. Okay, so which is the best buy order? The best buy order is the one with the highest buying price. And similarly, let's say there are various sell orders. Okay, so there is a sell order at 102. Okay, then there is one at 101.50, then there is a third one at 101.25, fourth one at 101. Okay, so which is the best sell order? The best sell order is the one with the lowest asking price or the lowest sell price. Okay, now suppose there are more than one orders at 101, buy orders at 101.50. Let's say there are three buy orders, all three at 101.50. Now, which one should be matched first? So here the exchange will look at the timestamp. The moment any order is punched in the trading system, okay, by the trading member, that order is given a timestamp, and the timestamp will be right to the last microsecond. Okay, so when there are more than one orders with the same price, the exchange will look at the timestamp of each order, and the one which has been entered first, okay, the oldest order, that will be considered for matching first. Okay, so this rule is known as price time priority. Price time priority means the best buy order is matched with the best sell order, but if there are more than one orders of the same price, then the order which has been entered first will be considered for matching first. Okay, so that is the meaning of price time priority. Now note that this is only one of the rules which is used for matching orders. Okay, like that there are different rules, but in India, okay, Indian exchanges follow this rule. It is quite possible that exchanges in Europe or US may be following a different rule, right? This is the rule followed by Indian exchanges. Okay. Now, one more important thing to note is that there are no price bands applicable in the derivative segment. So, in the cash market segment or in the capital market segment, typically you will have price bands. Okay. So, there would be some stocks which have a 5% price band, some other stocks which have 10% price band, and yet some other stocks which have a 20% price band. What does the price band mean? It means that if for any reason the price goes up suppose the price band applicable for a stock is say 10%. Okay, the moment the price, suppose on a particular day some very good news comes and the stock price jumps by 10%, then what will happen? There will be a freeze at that price. Okay, so then typically we say that upper circuit has been hit in that stock, so there are only buyers and no sellers. Or sometimes if extremely bad news comes, then the stock price may decline sharply by 10% in a single day. And if the price band is 10%, then there would be a freeze at that level and we say the lower circuit is reached. Okay, but these price bands are applicable only in the cash market segment, okay, where stocks are traded. In the derivative segment, there are no price bands. Okay, but in order to prevent erroneous order entry, operating ranges are specified. And so what is the operating range? Operating range is the range within which the price can move. Okay, and minimum maximum ranges are fixed for a given day. So for index futures, the operating range is 10% of the base price, and for individual securities also it is 10% of the base price. Okay, so in view of this, orders placed at prices which are beyond operating ranges would reach the exchange as a price freeze. So the purpose here is not to stop trading at that price, but simply to prevent, mistakes in order entry. To prevent any mistakes in order entry, these operating ranges are applicable. Now, this is just a view of the trader workstation. So as I said that, every trading member has a trading system, okay, in which the orders are entered, and this is basically the view of his workstation, okay, his terminal, what he will see on the terminal. So basically he'll see a title bar, he will see a ticker window of futures and options market. Then he will also ticker window means the window where continuous price feed. He will see the prices moving continuously. So there is a ticker window for futures and options as well as the underlying, that is capital market segment. Okay, so inquiry window, snap quote, order trade window, so system message window. So system message window means this is the window in which he will see any messages coming from the exchange. Okay, so again he has to keep track of whatever the exchange is telling him and all that, right? So these are the, so let's look at a couple of questions here. First question, which of the following is typically the primary criterion used in order matching for derivatives contracts? Okay, is it order size? Is it time of order entry? Is it price of the order? Or is it order type? Which is the primary criterion? Okay, correct answer is C, that is price of the order. Okay, because see, what is the rule used for order matching? Price, time, priority. That means what? First, the best buy order is matched with the best sell order, right? So first the price is considered, and if there are more than one orders of the same price, then only the time of order entry is considered, right? So the primary criterion for matching is price of the order. Okay, now one more question we will look at. What is the role of price time priority rule in the order matching process? To match orders based on the trader's previous trading history, to prioritize orders based on trading volume, to execute orders first based on best price and then by earliest time at which orders were placed, or to match orders based on the type of order. What is the role of the price time priority rule? Yeah, the correct answer is C, to execute orders first based on the best price and then by the earliest time at which orders were placed. Okay, so that is our, let me share the, okay, so right, okay. So now talking about derivatives, so you are all aware that all the stocks which are traded in the cash market are not available for trading in the F&O, okay, in the futures and options segment. So for instance, there may be more than 5,000 companies shares which are available for trading in the cash market. right? But all these 5,000 shares are not eligible for trading in derivatives. Okay, what is the reason for that? Reason is that for including a stock for trading in the derivative segment, SEBI has specified very stringent eligibility criteria, and only stocks which fulfill these eligibility conditions, they are allowed to be traded in the derivative segment. Okay, so what are these eligibility criteria? The first one is that the stock is chosen from amongst the top 500 stocks in terms of average daily market capitalization and average daily traded value in the previous 6 months on a rolling basis. What it means is that while choosing a stock for trading in the derivative segment, the exchange will look at its previous 6 months of trading history. Okay, it will look at the previous 6 months of trading history for that particular stock, and it will see if that stock has figured in the top 500 in terms of daily market capitalization. Now, I'm sure you know what is market capitalization, right? Market capitalization simply means the number of shares of that company into multiplied by the market price of the shares, right? So the stock must be among the top 500 stocks in terms of ranked by market capitalization. Okay, and also the among the top 500 stocks as per ranked as per average daily traded value. Okay, so over the last 6 months, did that stock figure in the list of top 500 stocks by market cap and top 500 stocks by average traded value? Okay, only if it has figured in the top 500, it will be selected for trading in derivatives. Okay, the stock's median quarter sigma order size over the last 6 months on a rolling basis shall not be less than rupees 25 lakhs. Okay, now this is a little difficult to understand. Okay, what it means is that the median quarter sigma order size. Okay, now typically sigma is used to denote the volatility of the stock. Okay, so suppose the volatility of a stock is say 20%. Okay, or then what it means is that, what do you mean by volatility of the stock? Volatility means how much the stock price fluctuates. Okay, so when I say the stock's annual volatility is 20%, what does it mean? That it means that suppose the stock price is 100, okay, then over a year the stock price can fluctuate within a range of 80 rupees to 120 rupees, right? So on the higher side it can go all the way to 120, and on the lower side it can fall all the way to 80. Okay, so when I say the annual volatility is 20%, that's what we mean. Okay, so sigma is used to denote the volatility of the stock. Okay, so what should be the order size? So let's say if the stock's annual volatility or sigma is 20%, then quarter sigma would be 5%, right? So if I place an order of 25 lakh rupees for, let's say, for selling that stock or for buying that stock, okay, then it should not move by more than 5%. That's what it means. Okay, so annual volatility is 20%. So if I place a large order, okay, so 25 lakhs is a fairly large order, right? So if I place a 25 lakh rupees order in that stock, whether it is for buying or selling, then the price move should not be more than quarter of its volatility. Okay, so if annual volatility is 20%, then the price move should not be more than 5%. Okay, so basically it should be a liquid counter. What do you mean by it should be a deep and liquid counter? That means what? If the stock has a lot of depth, market depth, that means it will be able to absorb any buying or selling. Okay, so if you put a large buy order, okay, it should not happen that the stock price immediately reaches upper circuit. Or if you put a large sell order in that stock, then the stock price should not immediately touch the lower circuit, right? So it should be the stock should be deep enough to absorb any heavy buying or selling orders. That's what it means. Then the market-wide position limit in the stock shall not be less than rupees 500 crore on a rolling basis. Now, what is this market-wide position limit? Okay, this we are going to study later, but I'll just give you a quick, preamble for this. So, market-wide position limit. So, in the derivatives market, there is a limit up to how much you can create positions in futures and options on a particular stock. Okay, and this limit is known as the market wide position limit for that stock. So each of the stocks which are eligible for trading in derivatives has a market wide position limit which is decided by the exchange. Okay, and so basically what it says is that the market wide position limit of the stock shall not be less than rupees 500 crore on a rolling basis. Okay, only then that stock is eligible for trading in the derivative segment. And average daily delivery value in the cash market shall not be less than rupees 10 crore in the previous 6 months on a rolling basis. So for a stock to be included for trading in the derivative segment, its cash market average daily delivery shall not be less than 10 crore. Okay, so these are the four eligibility criteria which any stock has to satisfy in order to be included in the derivative segment. Okay, now how does an exchange select an index for trading in derivatives? So there are different indices. Of course, we know that Nifty and Sensex are the most popular indices, but apart from that, there are other indices as well, like Bank Nifty or Bank X or Nifty Mid Cap 50 and all that, right? So now note that derivatives have not been introduced on all these indices, okay? Because there are certain strict criteria which even the index has to fulfill before the exchange can launch derivatives on the index. So what are these criteria? So first, the weightage of constituent stocks of the index which are individually eligible for derivatives trading should be at least 80%. So what does it mean? Suppose there is an index of say mid cap stocks. Okay, then and let's say there are 30 stocks in this index. Okay, then what it says is that at least 80% of these stocks which are included in the index should be eligible for derivatives trading. Okay, that means if there are 30 stocks in that index, then at least 24 of these stocks should be individually eligible for derivatives trading. Only then the index will be considered as eligible for derivatives trading. Okay. However, no single ineligible stock in the index shall have a weightage of more than 5% in the index. Okay, so we said that out of the 30, 24 stocks are eligible for trading in derivatives, but 6 stocks are not. Okay, now of these 6 stocks which are not eligible for trading in derivatives, no single, none of these 6 stocks should have a weightage of more than 5% in that index. Okay, so basically what the exchange wants to make sure that majority of the stocks which are included in the index are individually eligible for derivatives trading. Okay, only then that index will be considered for offering futures and options contracts. The index on which F&O are permitted shall be required to comply with the eligibility criteria on a continuous basis. Exchange shall check whether the index continues to meet the aforesaid eligibility criteria on a monthly basis, and if it fails to meet the eligibility criteria for 3 consecutive months, then no fresh contract shall be issued on that index. However, existing unexpired contracts will be permitted to trade till the expiry, and new strikes may also be introduced. So these eligibility criteria, they have to be complied with, and if they are complied with, then only exchange will allow futures and options to be launched on this index. Okay, but then the exchange continues to monitor the index in the future as well, and if the index fails to meet the eligibility criteria for 3 consecutive months, then no fresh contracts will be allowed to be introduced on that index. Okay, so these criteria are monitored continuously by the exchange. Okay, now there are certain criteria for evaluation of index derivatives. So firstly, 15% of the trading members active in all index derivatives or 20 trading members, whichever is lower, should have traded in any derivative contract on the index being reviewed in each of the month. Okay, so there are certain conditions which the exchange which have to be fulfilled, okay, on an ongoing basis. So exchange keeps monitoring the performance of the index derivatives. Okay, so let's say exchange has allowed derivatives on some index. Okay, some new index has been introduced and derivatives have been introduced on that index. Okay, now what is the basic condition is that the index derivative should be traded actively, and how do you know whether it is actively traded? So what the exchange says is that 15% of all the brokers who are active in that index, in all index derivatives, or 20 members, okay, 20 brokers, whichever is lower, should have traded. Okay, if this has been done, then it shows that the contract is actively traded. Okay, but if this condition is not satisfied, that means what? Nobody is actually actively trading in that contract. Okay, trading on a minimum of 75% of the trading days during the review period. Okay, so suppose there are 180 days in the review period. Okay, now 75% of this, which would be what? Roughly 135 days, right? So at least on 135 days, the contract should be traded in the previous 6 months. Average daily turnover should be at least 10 crore during the review period, and average daily open interest should be at least 4 crore during the review period. Okay, so these are the conditions which the index derivative should fulfill on an ongoing basis. And if these conditions are not fulfilled for at least for the continuously for 3 months, then exchange will stop the launching of further contracts on this index. Once an index is excluded from the derivatives list, it shall not be considered for re-inclusion for a period of at least 6 months. Exchanges may consider relaunching derivative contracts on the same index after carrying out suitable modifications in contract specifications based on market feedback after the cooling off period of at least 6 months, subject to SEBI approval. Okay, so suppose exchange has launched derivatives on a certain index, and let's say it is not very popular among the market participants. Okay, and therefore it has failed to take off. There is not that much interest by market participants, and therefore there is not sufficient trading volume, etc. And therefore the exchange has to stop the derivatives trading on this index. What the exchange can do, it can seek market feedback. It can ask participants what was wrong with the design of this contract, and suppose it gets a feedback from market participants that the lot size is too large. Okay, what is the lot size? Lot size is the size of the contract. Okay, so suppose this contract size was say 500, and market participants give a feedback that 500 is a very large contract size. We are comfortable with a contract size of 100. So exchange may, redesign the contract according to the market feedback, and then it can launch it after a cooling off period of 6 months, subject to SEBI approval. Okay, so this is how this thing index. So that was about how futures and options are launched on stocks and indices. Okay, now we will learn something about corporate actions. So what are corporate actions? So corporate actions are basically actions taken by a company. Okay, for example, payment of dividend. This is an action taken by a company. Issue of bonus shares. Face value split. Face value split means what? Suppose it is a share with a 10 rupees face value. The company may decide to reduce the face value to 5 rupees. Okay, that is a face value split. Then amalgamation. Amalgamation means basically coming together of two companies. Then something called merger. Okay, merger, what happens in a merger? One company is merged into another, right? So the company which is merged ceases to exist, right? And the other company into which it is merged, that company will continue. Okay, so amalgamation, merger, all these are examples of corporate actions. Now, whenever there is any corporate action, certain adjustments are necessary in the derivatives contract, okay, in the futures and options contract, because futures and options are basically contracts on the underlying shares. Okay, so if the underlying shares are affected because of the corporate action, then adjustments have to be made in the futures and options contract as well. Okay, so what is the reason? Why is it necessary to make adjustments in the futures and options contract? Okay, the reason is that the value of the position of the market participants on the come date and ex date for corporate action should continue to remain the same as far as possible. Now, what do you mean by come date and ex date? Okay, so come date is the last date before the corporate action is executed, and ex date is the first date immediately after the corporate action has happened. Okay, so for example, suppose a company announces a dividend. Okay, let's say a company announces a dividend of 5 rupees per share. Okay, now whenever a company announces a dividend, it will also announce the record date for that dividend. Okay, what is the record date? The record date is the date on which you have to hold shares in that company in order to be eligible to receive the dividend. Okay, so let's say a company announces dividend in the month of December, and it says that 15 January will be the record date for payment of dividend. Okay, that means all those investors who held shares in that company on 15th of January, they are eligible to receive the dividend. Now, let's say on 15th January, the share was trading at say 100 rupees. Okay, so this is the come date. What you can say, this is the date on which if I am holding shares on this date, then I am eligible to receive the dividend, right? Now, because the settlement happens on T+1. Okay, now suppose I don't have the shares, right? What is the last date on which I can buy the shares and still be eligible to receive dividend? So basically, if I buy the shares on any day till 14th of January, I'll be having the shares on 15th of January. So even if I buy the shares on 14th of January, because the settlement is on T+1, on 15th January, I will have the shares in my demat account, and 15th Jan is the record date, right? But if I buy it after 14th Jan, suppose I buy the shares in the market on 15th Jan, then I will not be eligible to receive the dividend. Why? Because even if I buy it on 15th Jan, the shares will be credited to my demat account only on 16th January, right? So 14th Jan is the last date on which I'll be able to buy the shares and be eligible to receive the dividend. Okay, so on 14th Jan, the price of the share on 14th Jan is known as the come dividend price. Okay, that is the come dividend price. And on 15th January, the price is known as the ex-dividend price, because if you buy it on 15 Jan, then you are not eligible to receive the dividend, right? So why should you pay the complete price? So let's say on 14 Jan, the share price was 100 and the dividend amount was 5 rupees. Then on 15 Jan, the price will fall by 5 rupees. So other things remaining constant, the share price will be around 95 rupees. Okay, so that if I buy on 15 Jan, I'll not be eligible to receive the dividend. So why should I pay 100 rupees? I'll pay only 95. Okay, that is the logic. Now, the share price falls to the extent of the dividend. Okay, now similarly, adjustments have to be made in the futures and options contract as well. Okay, because if the underlying shares have been adjusted, then similarly the terms of the futures and options also have to be adjusted. Okay, so what kind of adjustments are made? So adjustments are modifications to the positions or the contract specifications. So typically, which are the contract specifications that are adjusted? First is the strike price. So if it is an option contract, you know that every option contract can be exercised at a predetermined price, which is known as the strike price. So for an option contract, the strike price has to be adjusted, and the position and the market lot, that is the contract size also has to be adjusted. Any adjustment for corporate action shall be carried out on the last day on which a security is traded on a come basis in the underlying cash market after the close of trading hours. So in the example which I gave just now, okay, the come date for the dividend was 14 January. right? Come date was 14 January. So any adjustment will be calculated after the close of the market. So after 3:30 p.m. on 14 January, the corporate action adjustment will be carried out. Okay, so on the trading workstation screen, the different windows are displayed: bonus, rights, merger. So there are different windows for the different corporate actions. Okay, so these windows are displayed on the trader screen. Now, how is this adjustment carried out? So adjustment for bonus, stock split, consolidation, and extraordinary dividend. Okay, so bonus, stock split, and consolidation, all these are related to the number of shares. So for example, when there is a bonus, suppose the company announces a 1:1 bonus. Okay, that means every investor will receive one share for one share that is held by him. So what will happen is that the number of each shares issued, that will be doubled. So if earlier, suppose the company had issued 1 lakh shares, after the bonus issue, one share will be issued for every share held by the investor. So number of shares issued will go from 1 lakh to 2 lakhs. And naturally, if the number of shares is doubled, the share price will reduce by 50%. So share price will be halved, right? So suppose earlier the share was trading at 100 rupees. After the bonus, it will start trading at 50 rupees. So in case of the bonus issue, in case of options, so suppose it is a 1:1 bonus issue, then the share price reduces by 50%, right? So the strike price of the options will also reduce by 50%. And because the number of shares is getting doubled, then the contract size of the futures and options will also be doubled. So let's say earlier the contract size was 100, okay? Now the contract size will be 200. Okay, so there is an adjustment factor, and what happens is that the new strike price is arrived at by dividing the old strike price by the adjustment factor, and the market lot will be, new market lot will be the old market lot multiplied by the adjustment factor. So as I said earlier, suppose the market lot, the contract size of the market lot was 100. Now, because it is a 1:1 bonus issue, number of shares is getting doubled, so market lot will also be doubled. And because the share price is getting reduced by 50%, the strike price will be divided by 2. Okay, so that is how the this thing happens. The strike price and the lot size are adjusted. Okay, same adjustment is done for right shares also, but in case of right shares, many times it is possible that if or in case, even in case of bonus issue, many times it may so happen that if the ratio is a little awkward, then the resulting number of shares might be in fractions. Okay, now obviously share in India, shares cannot be issued as fractions, so the fraction amount is settled in cash. Okay, so let's say if a company issues bonus, of 3:1, that means 3 shares will be issued for every 7 shares that the investor is holding. So the number of shares might come in fractions, right? So what it does is that shares are issued in whole numbers and the fractional amount is settled in cash. Okay. Now again, adjustments are needed whenever extraordinary dividends are paid by the company. So many times, companies issue extraordinary, companies announce extraordinary dividends. So for example, let's say it is the company has completed, say, 50 years. Okay, so it is its 50th year, or it's a golden jubilee year. Okay, so in that year, the company may announce a very, very generous dividend of, say, let's say 100 rupees per share. Okay, now this is an extraordinary dividend. Normally the dividend which is announced is, let's say, 5 rupees or 10 rupees per share, but because it is the golden jubilee year, the company may announce a special dividend of 100 rupees per share. Now these kind of dividends are known as extraordinary dividends. So what are extraordinary dividends? So they have been defined as, if the dividend is greater than or equal to 2% of the market price of the shares, then it is termed as extraordinary dividend. Okay, so let's say the market price of the shares is, say, 500 rupees, and the company has announced a dividend of 100 rupees. So the dividend is what, 20% of the market price of the share. So it is a huge amount, right? So this is called an extraordinary dividend. Okay. So in case of extraordinary dividends, what adjustments are necessary? So firstly, the strike price will be adjusted. Okay. So for extraordinary dividends above 2% of the market value of the underlying security, all positions in the existing strike price shall continue to exist in the corresponding new adjusted strike prices. Okay. So suppose I was holding an option, let's say I was holding a call option in the shares with a strike price of 500. Okay. Now, subsequent to this, after the come dividend date, what the exchange will do? Exchange will reduce my 500 strike price to 400. Why? Because 100 rupees is the amount of dividend, right? So my strike price of 500 will be reduced to 400. Okay. Why is this adjustment necessary? Because let's say earlier the stock was trading at rupees 500 and I was holding a call option with a strike price of 500. So my option was at the money. Okay. Now after the stock goes ex dividend, that is after that 100 rupees dividend has been paid, the stock price will fall to 400. Okay. Now if my option contract is not adjusted, okay, if my strike price is still at 500, then what it means is that my option which was earlier at the money, now it has become out of the money. But why has the option become out of the money? Because the stock price was adjusted after payment of dividend. Okay, not because of any other reasons, right? So I should not suffer just because of the corporate action. So what the exchange will do, it will reduce my strike price also to 400. Now again my option has become at the money. Okay, so the idea of corporate actions is that the position of the investor, okay, or the position of the person who is holding the futures and options contract, that as far as possible it should remain the same as it was before the corporate action. Okay, so earlier my option was at the money before the corporate action. After the corporate action also my option should remain at the money, and therefore the strike price is adjusted. Now again, what happens in case of merger? Merger or demerger. Okay, so let's say there is company A. Company A is being merged into company B. What will happen is that after the date of the merger, company A will cease to exist and only B will continue to exist. Okay, so or if there were futures and options contract traded on the shares of company A, right? These contracts will cease to exist after the date of the merger. So this has to be informed. So let's say the merger date was 15th of January. After 15th of January, all F&O contracts on company A stock will cease to exist. So exchange has to inform this to the members, okay, that these contracts will cease to exist on 15th of January. And no fresh month contracts will be introduced on company A shares, because company A will be merged with company B. So after 15 Jan, no new contracts will be introduced on company A shares. And okay, and let us say the merger was going to happen on 15th of January, and let us say on that date uh, there were contracts of February. Okay, let's say the merger was announced somewhere in December. So in December we already had December, January and February contracts. So let's say on 15th of January the February month contracts were still existing on the shares of company A. Okay, so if the merger happens on 15 Jan, okay, February contracts are still in existence. So February contracts will cease to exist on 15th of January. Okay, and they will be compulsory settled on 15th of January at the settlement price. Okay, because obviously, because the company has itself has ceased to exist, because this company A has merged with company B, right? So, and the merger happened on 15 January. So, if there are F&O contracts for the month of February, which are still outstanding on company A, these contracts will be compulsorily settled on 15th of January, and the settlement price will be the last available closing price of these shares in the capital market segment, right? So, that's how. Okay, so that is all about corporate actions. Now let's talk about the trading costs. So anybody who trades in equity derivative segment incurs different types of costs. Okay, first we can classify them into user charges and statutory charges. What are user charges? User charges is basically the brokerage which is charged by brokers. Okay, so anybody, whenever you place order, okay, with a broker, he charges brokerage, right? Brokerage is usually lower for intraday trades, and rates of brokerage, they differ from from one broker to the other. Traditionally, full service brokers are those which offer research and all other things, or other services. Those brokerage for those brokers, full service brokers, is much higher. Okay, whereas discount brokers are typically those which offer minimal services. So discount brokers usually charge very low brokerage. And apart from brokerage, there are statutory charges such as STT, GST, stamp duty. All these are also paid. So these are the statutory charges. And there is a third cost which is known as impact cost. Now, user charges and statutory charges, you can actually see them. Okay, you can actually count them. You can see them. These are what known as explicit costs. And there is something which you cannot see. There is a hidden cost in the form of impact cost. So what is this impact cost? It is basically, impact cost is it is a measure of how liquid that counter is. Okay, so suppose you place an order for buying, let's say you place an order for buying two lots of futures contracts in a particular stock. Okay, now by how much the stock price, the futures price will jump. Okay, or let's say somebody puts in a very heavy sell order. Okay, somebody puts a sell order for, let's say, 100 lots in that particular futures contract. Okay, then probably the futures price will decline sharply. Okay, so by how much it will decline? Okay, so what is the impact on the market price of that contract if a very large buy or sell order is placed? That is that is termed as the impact cost. Okay, now what is the importance of this impact cost? That if the counter is liquid, okay, if it's a liquid and deep counter, then any large buy or sell orders will not disturb the price by that much. Okay, so more liquid is the counter, more liquid is the scrip or the contract, lower will be the impact cost. So there is an inverse relationship between liquidity and the impact cost. Higher the liquidity in the stock or the contract, lower will be the impact cost. Okay, so impact cost is an invisible cost which you really cannot see. Okay, now what are the rates of STT? So you all know that for equity derivatives contract which are traded on the exchange, STT has to be paid, right? So what is the STT to be paid on sale of an option? That the rate is 0.0625% and it has to be paid by the seller, and this is calculated on the option premium. But when the option is exercised, now you know that only the buyer of the option can exercise the contract, right? Only the buyer can exercise an option. So when an option is exercised, then the buyer of the option has to pay STT of 0.125%, and this STT is calculated on the settlement price of the option. Okay, and similarly on a futures contract, when the futures is sold, okay, then seller has to pay STT, which is equal to 0.0125% of the futures price. Okay, apart from STT, GST is also charged at 18% on the brokerage plus the transaction charges. Okay, and both STT and GST, they are collected by the government, and therefore they are known as statutory charges. Okay, apart from that, stamp duty is also charged, and SEBI turnover fees are also charged. So these are all the explicit costs. Now, moving on to how trading is conducted. So there is today, most of the trading that takes place on the derivatives market is algorithmic trading. So what is algorithmic trading? It is a process of executing orders utilizing automated and pre-programmed trading instructions. to account for variables such as price, time, and volume. It is a set of directions for solving a problem, basically a mathematical model developed by programmers and is fed into a computer. The model considers the changing market conditions such as security prices, traded volumes, time of the day, etc., and dynamically places buy and sell orders in the market. The biggest advantage is that because placing of buy sell orders is automatic and computer driven, the individual trader's emotions are not allowed to affect his or her trading decisions. So I'll give you an example. So there are various types of algorithms. So what is an algorithm? It is basically a computer program. Okay. And the computer is directed that if certain conditions are met, okay, then the computer will automatically fire buy or sell orders in a particular stock or in a particular index. Okay. So typically, let's say the computer is, say, let's say the index is trading at say 23,000, and let's say the investor feels that if if it reaches 22,800, then it is a very strong support, technical support, and it is unlikely to go below 22,800. So the computer is programmed that whenever the index touches 22,800, you fire buy orders in the index. Okay, so this is just a very, very simple example. Now, let's say I'll give you another example. Suppose there is a fund manager and he wants to buy, let's say he wants to buy 5 lakh shares of a particular company. Okay. But now the problem is that if he buys the entire quantity of 5 lakh shares at one go, okay, in a single order, what will happen is that the share price may jump. Okay. So his buy order may not be executed immediately, correct? So let's say, he places an order for buying 5 lakh shares, and let's say 1,000 shares are bought at a particular price, and then next 2,000 shares are bought. But then as the market sees that somebody is continuously buying shares in that company, the market participants will react. They will naturally react by raising the share price. So by the time his entire order of 5 lakhs is executed, the share price may have gone up by 10%, right? So to avoid this adverse impact on the share price, the fund manager may want to spread his entire order throughout the day. So instead of buying all the 5 lakh shares at one go, he may decide to buy it in small installments. So the same order can be broken down into small installments and it can be executed throughout the day. Okay. So the computer will execute the order in small installments or small tranches in such a way that there is no adverse impact on the market price. Okay. So this kind of algo is known as the VWAP algo. VWAP means volume weighted average price. So the computer is told, it is programmed that buy the shares in such quantities, okay, in such a way that the volume weighted average price does not rise beyond a particular number. Okay, so let's say at the beginning of the day, let's say in the morning, the share price was 100. Okay, the computer is programmed that the order for buying 5 lakh shares should be executed in such a way that the volume weighted average price, okay, for that day should not exceed, let's say, 102. Okay, so the entire order will be split into several small orders and it will be bought throughout the day. Okay, so that the adverse impact on the share price is minimized. Okay, so this is just one example of an algo. Like that, there are several algos depending on what is the objective of the investor. So huge advantage is that algo trading reduces the overall time taken for order execution because computers can place orders at far higher speeds than human operators. So earlier, another example is of arbitrage. Okay, so what is arbitrage? Arbitrage is simultaneous buying and selling of, say, stocks. One example, I'm just giving you an example, simple example of arbitrage. Let's say there is a stock which is trading on two different exchanges. Okay, and on one of the exchanges, the stock is trading at 100 rupees and on the other, it is trading at 101. Okay, so typical arbitrage would be to buy the stock at the exchange where it is cheap. Okay, so buy it at 100 on exchange A and sell it on exchange B at 101. So earlier, this operation used to be done by human beings. They were known as jobbers. Okay, So jobbers would be continuously monitoring the stock price on both the exchanges, and they would snap it up on the cheaper exchange and sell it on the exchange where it is more expensive. Okay, but today this function is now performed by computers. So there are very, very fast algorithms which continuously monitor different exchanges. And the moment they see this kind of arbitrage opportunity, the computer itself will fire the buy and sell order, right? So the order will be executed at very, very high speeds. Okay. And that kind of speed is not possible for human beings. Computers can execute the orders very fast, within the blink of an eye, the order can be executed. High frequency trading is an offshoot of algo trading, which allows the trader to make tens of thousands of trades per second. So high frequency means trading at very, very high frequencies. Okay. So trades can happen, though the computer can fire, let's say, 10,000 trades within 1 second. Okay. So, sorry, it can fire 10,000 orders, buy or sell orders within 1 second. So this is known as high frequency trading. Now, algo trading is mainly used by institutional investors and large brokers to cut down their trading costs. But SEBI has allowed retail investors also to use algo trading strategies, and some brokers allow their retail clients also to use these kind of strategies. Okay, so that was about algo trading. Now, how do you track the futures and options data? So earlier, daily newspapers were the chief source of information. So even today, many newspapers, for example, Business Standard, they give, all the futures and options data, okay, in great detail. And so they will give, what is the, traded price or the open interest or the traded volume and the price in both the spot market as well as the F&O market that will be given by the newspaper. But now we don't have to depend on newspapers because we can track all this data on the exchange website on a real-time basis, okay, as well as on the brokers trading platforms, okay. So what kind of data can be tracked? So all this, so for example, what is the opening price, high price, low price, what is the closing price for that contract, what was the last traded price, what is the open interest, what is the trading volume, all this can be tracked on a real-time basis. So before we go ahead, let's understand what is the meaning of this data. So what is open interest? So open interest is the number of contracts that have been opened, that is the number of positions that have been taken and not yet closed. Okay, so for futures contracts, it is the equivalent of the open positions in that futures contract multiplied by the last available futures closing price. And for options, it is the number of open positions multiplied by the notional value of the option contract. Then total traded quantity. Okay. So total traded quantity means traded volume. So number of contracts which have been traded, which have been exchanged on that particular day. And total traded value is the money value, the value in rupees. Okay. Number of shares multiplied, number of contracts multiplied by the rupee value. And number of trades means simply how many trades took place on that contract during that day. Okay. So all this data can be tracked. Closing data is all obviously available on the website of the exchange, and you can also track it on a real-time basis throughout the day. Now, how do you interpret the trend, okay, in the market? Okay, so positive trend. So you can also look at the, which are the top gainers in the futures market. Okay, so you can see which are the top traded, not top traded, but the contracts where the price has gone up the most. Okay, and similarly, you can look at the top losers. So which are the futures contract where the price has fallen the most on that day. Then futures OI gainers, right? So those contracts where the open interest has increased, okay, the most during that day. So percentage increase in open interest is the highest on that day. And futures OI losers are again those contracts where the open interest has fallen by the most on that day. Then active calls. Active calls means the call option contracts where the trading volumes is the highest on that day. And active puts is where the put options with the heaviest trading volume for that day. Okay. So all this information you can find on the website of the exchange or on any website, for example, moneycontrol.com, or for any particular broker also, you can look at the this kind of data. Okay, so let's look at some random questions. How has the use of algo trading impacted the options market? What are the options? It has decreased the overall trading volume in the options market. It has led to more frequent and smaller trade sizes, improving market liquidity. It has reduced the number of participants in the options market. It has made options trading less transparent and more prone to manipulation. Which is the correct answer? Any idea? Okay, the correct answer is it has led to more frequent and smaller trade sizes, thus improving the market liquidity. Okay. Uh, One more question. What is a common trend observed in the volatility of options market during major economic announcements? Decreased volatility as the market adjusts to new information, increased volatility as traders react to uncertainty, stable volatility, and immediate elimination of all market risks. What is the trend observed? How does volatility change in the options market whenever there are going to be major economic announcements? For example, suppose monetary policy announcement. Let's say RBI is expected to announce a monetary policy during the day. What will be the effect on the volatility? So the correct answer is that increased volatility. Okay, so prior to the announcement, volatility will be very high. Okay, so that is the common trend. Okay, so let me just share the screen and okay. So we have looked at trading mechanism of equity derivatives so far. Now let's look at the clearing and settlement. Okay, I hope the screen is visible. So let's understand how the clearing and settlement happens in the equity derivatives market. Okay, so the first thing that you should know is that the clearing corporation is responsible for clearing and settlement of all trades executed. Okay, the clearing corporation is known as the central counterparty. Okay, central counterparty means it stands between the buyer and the seller. Okay, so normally to any transaction you have two parties. One is a buyer, the other is a seller. But the clearing corporation stands between these two, and it is known as the central counterparty. And the function of the clearing corporation is to ensure clearing and settlement of the trades, right? So what is the function? So suppose the buyer were to default. Suppose the buyer to the transaction, he defaults in payment of the money. Then the clearing corporation will pay the amount to the seller on behalf of the buyer, and it will ensure that the contract is closed. Similarly, if the seller of the contract fails to deliver the underlying security, then also the clearing corporation will step into the shoes of the seller, and it will deliver the security to the buyer, and once again it will ensure that the contract is settled. Okay, so what is the function of the clearing corporation? To stand between the buyer and the seller, and to step into the shoes of the defaulting party and ensure that the contract is settled. Okay, so basically the clearing and settlement process consists of three main activities. The first is clearing, the second is settlement, and the third is risk management. And clearing and settlement activities are undertaken with the help of clearing members and clearing banks. Okay, so what is the difference between clearing and settlement? So clearing means computing the obligations of all the trading members of the clearing member, And settlement means performing the actual settlement. And risk management means setting position limits based on the deposits margins received for each trading member and monitoring their positions on a continuous basis. Okay, so clearing members. So we know that in the futures and options segment, there are trading members. Trading members are the actual brokers who receive orders from their clients and who, punch in the orders in the trading system. But every trading member has to clear and settle his trades through a clearing member. So clearing member is responsible for clearing and settling all the trades executed by his trading members. Okay, so what are the functions of the clearing member? To clear the trades, to settle the trades, and which are done by his trading member, and to continuously monitor the positions of his trading member. Okay, so who is eligible to be a clearing member of the exchange? In order to be eligible, the clearing member should have a net worth of at least rupees 300 lakhs, that is 3 crore, and for a self-clearing member, right? Somebody who clears and settles only his own trades. Okay, self-clearing member need to have a minimum net worth of 1 crore, but for other trading cum clearing members, the minimum net worth should be at least 3 crore. And besides this minimum net worth, he has to place a deposit of rupees 50 lakhs with the clearing corporation, which is termed as a security deposit, and then additional incremental deposits of rupees 10 lakhs for each additional trading member. Okay, so let's say it's a trading cum clearing member, that is he clears his own trades as well as trades of other members, and let us say he has got 5 trading members who clear and settle trades through him. Okay, so for each of these 5 trading members, he has to place an additional deposit of 10 lakhs with the clearing corporation. So for 5 trading members, he will have to keep a additional deposit of 50 lakhs. Okay, so this is the every clearing member has to have a minimum net worth. He has to place a security deposit of 50 lakh with the exchange, and he has to keep additional deposits of at least 10 lakh for each trading member who clears and settles through him. Right? Now, we said that the first function of the clearing member is to clear the trades. Right? So what is clearing? So clearing process is the calculation of open positions and obligations of the clearing members. The open position of a clearing member is arrived at by aggregating the open positions of all the trading members and all custodial participants clearing through him. Okay. Open position of a trading member is arrived at by adding up his proprietary open position and client's open position in the contracts which they have traded. While entering orders on the trading system, TMs identify orders as either proprietary or client. Okay. So a trading member can see what are proprietary orders. Proprietary orders are when the trading member is trading on his own behalf, right? So let's say the trading member uses his own capital and buys and sells on his own behalf. These are known as proprietary trades. And whenever he executes orders on behalf of his client, they are known as client trades. Okay, so he has to identify each order as either pro or client. Okay. Now, proprietary positions are calculated on net basis, that is buy minus sell for each contract, and that of clients are arrived at by summing up net positions of each individual client. So let's say the trading member, let's say on his own account, that is on his proprietary account, let us say he has bought 10 contracts of Nifty futures and he has sold 8 contracts, right, of Nifty futures, right? So what is his net position in Nifty futures? 10 minus 8 or 2. Okay. Now for each client, let us say he has got 5 clients and each of them has bought and sold Nifty futures contract. Okay. So what is the client position? Client position will be the total of the net positions of each client. So for each client, he will arrive at a buy minus sell position for that contract, and for each of the 5 clients, he will add up their positions and he will arrive at the gross position of the clients. So the trading member's open position is the sum of the proprietary open position, client open long position, and client open short position. Okay. So the trading member's position is his own position, that is proprietary position, plus long position of his client plus short position of his clients. Okay. Now remember that the net position in each contract. Okay. First, for each client, he has to arrive at the net position in each contract. Okay. So let us say there is client A. Client A has bought 10 Nifty futures contracts, and let us say he has sold 6 contracts. Okay. So client A has a net position of 10 minus 6, right? So he has a net long position of 4 contracts. And let us say client B has done the opposite, right? Let's say client B has a short position of 10 contracts, and then he bought back 6 contracts. Okay, so what is the net position of client B? 10 minus 6, that is 4, but this is a short position. So client A has a long position of 4 contracts, client B has a short position of 4 contracts. Now, can we say that the total client, so suppose these are the only 2 clients, can we say that the client position is 0? No, we cannot say that. Why? Because the client position cannot be netted across clients. Okay, he cannot say that because client A has a long position of 4 and client B has a short position of 4, the net client position is 0. No, that is not. The client position is the aggregate of the total position across clients. So what is the client position here? The client position is 4 contracts long and 4 contracts short. Okay. So the client position is grossed. It is first netted at the client level and then it is grossed up across the clients. Okay. So let's look at this example. Let us say there is a clearing member A and he has got 2 trading members PQR and XYZ. Okay. Now PQR has traded on his proprietary account. On the proprietary account, what he has done, he has bought 5,000 contracts and sold 3,000 contracts. So he has a long position of 2,000 contracts. Then PQR has 2 clients, client 1 and client 2. Client 1 has bought 3,000 contracts and sold 2,000. So client 1 has a long position of 1,000 and client 2 has a long position of 2,000. Okay. So for the for the trading member PQR, what is the total position? 2,000 long on proprietary account, 1,000 long for client 1 and 2,000 long for client 2. So the total position is 5,000 contracts long. Okay. Now for trading member XYZ, on the proprietary account, he has a short position of 1,000 contracts. Client 1 has a long position of 1,000 contracts and client 2 has a short position of 1,000 contracts. Okay. So what is the total position of client for XYZ trading member? The total position will be 1,000 contracts long and 2,000 contracts short. Okay. Now remember, the position cannot be netted off across the clients. He cannot say that client 1 has 1,000 long and client 2 has 1,000 short, so net position is 0. He cannot say that net client position is 0, right? Because the positions cannot be netted off across the clients. And similarly, he cannot net off the proprietary position against the client position. He cannot say that my proprietary position is 1,000 short and client 1 is 1,000 long, so I will net it off. No, such netting off is not allowed. Okay, so position has to be grossed across all the clients and added to the proprietary position. Okay, so here the position will be 1,000 long and 2,000 short. Okay, so the total long position of clearing member A is 6,000 long and total short position is 2,000 short. Okay, so the position is first netted off at the client level, then it is grossed up across all the clients, it is added to the proprietary position, and this is how the trading member position is arrived at. And then the position is again summed up across all the trading members, and this is how the clearing members position is arrived at. Now,
Sorry to interrupt, ma'am.
Yeah,
Can we have break for 15 minutes?
yeah, sure. We can have. So when we will assemble then?
11:47.
Oh,
Everybody, please be there at 11:47.
okay. Thank
Okay.
you.
Thank you, ma'am.
Yeah. Okay, can we start? I hope my screen is visible. Okay. So, before we stopped, I was talking about interoperability. Okay. What is this interoperability of clearing corporation? So, this is a concept recently introduced by SEBI. So, earlier the situation was that if a broker traded on some exchange, then the trade had to be cleared and settled with the clearing corporation of that exchange only. So, as you are aware, every exchange has its own clearing house or clearing corporation, which handles the clearing and settlement of all the trades which are executed on that exchange. So, for example, if a broker uh, made any, if a broker had traded on NSE, then that trade had to be cleared and settled by NSE's clearing corporation alone. Okay. Now, with the advent of interoperability, even if a broker trades on any exchange, either NSE or BSE, he can select that, he can decide that all his trades, okay, wherever the trades are executed, all his trades will be cleared and settled by a single clearing corporation. Okay, so even if the trade has been executed or NSE or BSE or MSE, the Metropolitan Stock Exchange, the trader can decide that all these trades will be cleared by, say, BSE Clearing Corporation. Okay, so he can select the clearing corporation which will clear and settle all his trades regardless of the venue where the trade has been executed. Okay, the advantage of this is that earlier when the trader had to clear and settle at different clearing houses, he had to maintain margin, collateral, funds, etc. with different clearing houses, right? Now he has decided that all his trades will be settled by a single clearing house, so he needs to maintain collateral, margin, etc. at a single clearing house. Okay, so this leads to better utilization of resources. Okay, so that is the advantage of uh, interoperability. Okay, so let's just have a quick question. What is the primary role of a clearing corporation in the derivatives markets? So is it to set the interest rates for derivative contracts? Is it to facilitate the trading of derivatives, to guarantee the performance of trades and ensure the settlement of contracts, or to provide financial advice? Which is the primary role of the clearing corporation? Any answers? Okay, so the primary role is to guarantee the performance of trades and ensure the settlement. Okay, that's the primary role, because every clearing corporation has to give settlement guarantee, right? It has to guarantee that whatever trades are executed on the exchange platform will be cleared and settled. So that is the primary role. Okay, so that's the first part of our clearing and settlement. Uh, let's move on to the next part. Let me share my screen. Right? So let's look at how the clearing and settlement happens. Okay, settlement. So since October 2019, all positions in futures and options on individual securities which remain open on the expiry date are required to be settled by physical delivery. So a very important change was brought about in October 2019 by SEBI. So prior to October 2019, all futures and options contract in stocks as well as the index were settled in cash. Okay, cash settlement means the settlement happens in terms of rupees, right? So just the difference is exchanged in rupees. Now, from October 2019, SEBI made it compulsory that all futures and options contracts which are open on the expiry date, okay, all these contracts on individual stocks will be settled by physical delivery, and uh, futures and options contracts on indices, Okay, indices like Sensex or Nifty or Bank Nifty. So the index futures and options contract will be settled in cash, but F&O contracts on individual stocks will be settled only by physical delivery. So this is a very, very important change which happened on from October 2019. Okay, now futures and options. Okay, these are the two main instruments which are available for trading in Indian derivative markets. Okay, so in futures contracts there are two types of settlements. One is the daily mark to market settlement and the other is the final settlement. So what is this daily mark to market settlement? So mark to market is a process by which margins are adjusted based on daily price changes in the market for the underlying asset. Okay, so every day the exchange computes a mark to market margin for the futures contract. Okay, and how is this computed? So the the three ways in which mark to market margin is computed: the traded price and the day's settlement price for the contracts executed during the day but not squared off. What does it mean? So let's say today morning I took a long position. That is, I bought a futures contract of say Reliance. Okay, I bought a futures contract in Reliance, and the futures price, the price at which I bought it was say 1,200. Let's say at the end of the day, the same contract, the contract had a settlement price of 1,250. Okay, so at the end of the day, the contract settlement price was 1,250. Okay, so I have a mark to market gain of 50 rupees, 50 rupees per contract. Okay, so the difference between the price at which I bought the contract and the day end price, okay, that is 50 rupees. So that is a mark to market gain. Previous day's settlement price and current day's settlement price for brought forward contracts. So let us say yesterday I had bought an ITC futures contract for 450. Okay, and I did not square it up at the end of the day. I carried it forward today. Okay, now yesterday the contract closed at 455. Okay, yesterday the contract closed at 455, and I carried my position forward till today, and today it closed at, let's say it closes at 465. Then the difference between today's settlement price and yesterday's closing price, okay, that is the mark to market gain. Okay, and the third is the buy price and sell price for contracts executed during the day and squared off. So let's say I bought some stock futures contract today morning at say 100, and by afternoon I squared it off at say 105. So the difference between my buying price and selling price, that is taken as a mark to market. That is, they are taken as a mark to market margin. So the sum of all these three. Okay, so for various positions, all these differences are computed, and that becomes the mark to market margin. Now, if this results in a loss, if it is a mark to market loss, the exchange collects this amount from the party which has the mark to market loss, right? So let's say I have taken a long position and I have a mark to market gain of 100 rupees, right? That means the person who has taken the short position in that same contract, that person has a 100 rupees loss, right? So what the exchange will do, it will collect 100 rupees from the clearing member of that client which has a 100 rupees loss, and it will transfer this amount to the clearing member of the person which has the 100 rupees mark to market gain. Okay, so on a continuous basis, every day all the open positions are mark to market at that day's settlement price, and any mark to market loss is collected from the clearing member of the client who has the loss, and it is transferred to the clearing member of the client who has made the mark to market profit. Okay, so this is known as daily mark to market settlement. Okay, so now I said that all these positions are mark to market at that day's settlement price. So what is the settlement price? The settlement price is a special price which is calculated by the exchange. Okay, it is not the last traded price. Okay, it is not a market price. It is a price which is calculated by the exchange as per a formula. And what is the formula currently followed by Indian exchanges? The settlement price is the last 30 minutes volume weighted average price for that futures contract. Okay, so suppose I have taken a long position in the Reliance February futures contract. Okay, how will the settlement price be arrived at? So today the exchange will look at what are all the different trades that have happened in the Reliance February futures contract between 3 p.m. and 3:30 p.m. Okay, each of these trades will be at some price. So the price multiplied by the quantity traded at that price. Okay, the average of this is the volume weighted average price, right? So average of this is arrived at, and that becomes the settlement price for the Reliance February futures contract for today. Okay, so why does the exchange arrive at a settlement price? Why does it not use the simply the last traded price? The reason is that the last traded price can be manipulated. Okay, market participants may try to manipulate the traded price by placing very high large buy or sell orders right at the close. To prevent such manipulation, the exchange calculates the settlement price. Okay, so that is the that is the price which is used for mark to market settlement. Now all this daily mark to market is cash settled, which means that the next day, suppose I have a mark to market loss of 100 rupees today. Okay, then I have to pay this immediately. Immediately means before the trading starts tomorrow. Okay, I have to make a payment of this 100 rupees to my broker, and my broker in turn will make the payment to the exchange. Okay, so all losses, mark to market losses, are collected by the exchange before the start of the trading on the next working day. Okay, so the pay in and payout of the daily mark to market settlement is effected before start of market hours on the next day as per the settlement schedule. And the settlement takes place by debiting the clearing accounts of clearing members. So the clearing member of the client who has a mark to market loss, that clearing member's bank account will be debited with the amount of the loss, and the bank account of the clearing member whose client has a mark to market profit will be credited with the amount of the mark to market profit. Okay, so this pay in payout happens before the trading starts for the next day. Okay, now this is known as the daily mark to market settlement. What is final settlement? Final settlement happens on the expiry day of the futures contract after the close of trading. So after the close of trading, the clearing corporation marks all the open positions to the final settlement price. All long positions are automatically assigned to short positions with the same series on a random basis for either cash settlement or for delivery settlement, whichever is applicable. Okay, so suppose I have taken a long position in Nifty futures contract and my position is open on the expiry day. Okay, then at the close of market, at the close of trading on the expiry day, my long position will be assigned to somebody who has a corresponding short position in the same Nifty futures contract. Okay, and like that the positions will be settled. So if it is a index futures contract, the settlement will be in cash. Okay, but if it is a stock futures position, then settlement will be by physical delivery. Okay, so what is the final settlement procedure for cash settled futures contract? Okay, so all positions brought forward, created during the day or closed out during the day at the close of trading hours on the last trading day are cash settled. They are marked to market at the final settlement price and they will be settled. Okay. So how is the settlement? So for index futures, the settlement will be by in cash, and for stock futures, settlement will be by physical delivery. So how will the settlement happen for stock futures? So in case of physically settled futures contracts, the final exercise settlement is implemented on T+1, where T is the expiry date. So if expiry date is say 27th of January, then the settlement will happen one day after, that is on 28th of January. The delivering clearing member must complete delivery instructions for transfer of securities to the depository pool account. And so basically, suppose I have taken a long position in Reliance futures contract, and let's say my position is open on, say, the expiry date. Okay, so one day after the expiry date, I need to make payment. Okay, I have a funds paying obligation, so I need to make payment of the underlying shares. That is, in this case, I have take a long position in Reliance futures, right? Suppose the contract size is 500 and I have long position in one lot. Okay, that means I am obligated to buy 500 shares of Reliance. So on one day after the expiry, I am under an obligation to buy 500 shares by paying the futures price. Okay, so I need to make the payment to my broker. My broker will make the payment to the exchange. And the other party, the opposite party, that is the one who has a short position in the Reliance futures contract, that client has the obligation to deliver the shares. Okay, so the clearing member of that client will deliver 500 shares to the exchange, right? So those 500 shares will go to the depository, and the depository will then transfer them to the buyer. Okay, so the buyer has a funds pay-in obligation and the seller has a securities pay-in obligation. Okay, so this is how the settlement happens. Now, so that was regarding futures contracts. What about option contracts? Option contracts again have two types of settlement. There is something called a daily premium settlement and there is something called a final settlement. So what is daily premium settlement? So any person, any client who buys an option needs to pay the premium, right? So whenever you buy an option, the option premium has to be paid. So the pay-in of this option premium happens on the one day after the trade, right? So today if I buy any option, suppose today I buy option on any particular stock, then the payment of the premium has to be effected tomorrow, right? Or whatever is the next working day. Okay. So I need to pay the premium to my broker and my broker in turn needs to pay the premium to the exchange. Okay. So this is called daily premium settlement. And what is the final exercise settlement? So for options, the final exercise settlement happens one day after the expiry. Now, in case of options, remember there are there are three types of contracts: in the money, at the money, and out of the money. Okay, in the money contracts are those which are profitable for the option holder to exercise, whereas at the money and out of the money contracts are not profitable for exercising. Okay, so on the expiry day, only the in the money options will be automatically exercised by the exchange. That means the option holder does not have to do anything. He does not have to give any instructions to the broker. The exchange will automatically exercise all the in the money option contracts. Now, again, how does this exercise happen? For index options, the final exercise is in cash. The final exercise settlement is in cash. Obviously, because same as in the case of index futures contracts. Why is the cash settlement allowed in case of index futures and options? Because it is very difficult to deliver an index, right? You can deliver an individual stock, but it is extremely difficult to deliver an index, and therefore index futures and options are allowed to be settled in cash. Now, how is this settlement value arrived at? So for call options, the final settlement value is the closing price of the index on the day of exercise minus the strike price. And for put options, it is the strike price of the option minus the closing price of the index. Okay, so this difference is multiplied by the lot size of the contract, and that becomes the settlement value. Okay, so this will have to be settled in cash, and this will have to be paid on the day after the expiry. So basically, how does this work? So let's say I have bought a call option on say some index, okay, with a strike price of 10,000. So I'm holding a call option on the index with a strike price of 10,000, and let us say the contract size is 50. And let us say I have only one contract. Okay. Now let's say on the expiry date, the index closed at 10,500. Okay. Now this is a call option. Okay. So it is definitely in the money. So what is the difference? The difference between the closing price, which is 10,500, and my strike price, which is 10,000. This difference is 500. So 500 multiplied by the lot size, which is 50. So that means 25,000. Okay. So my option is in the money to the extent of 25,000. So I will receive a payment of 25,000 on T+1. And who will make this payment to me? This payment will come from the person who has sold this call option. Because the call option which I bought was in the money, then obviously it has a loss for the call seller. So the call seller will be required to make a funds pay-in of 25,000, and I will receive this amount in my bank account, and this settlement will happen on the 1 day after the expiry, that is on T+1 day. Okay, so index options are settled in cash, but options on individual stocks, that is stock options, they are settled by physical delivery, because remember we said that from October 2019 SEBI has made it compulsory for stock options to be settled by physical delivery. Okay, again here the physical delivery will apply only if the option has expired in the money. If the option has expired out of the money or at the money, then there will be no physical delivery. It's only applicable for in the money. So how does the settlement happen here? So for in the money call options, exercise of a long call results into a buy position, and assignment of a short call results into a sell position. And for in the money put options, exercise of a long put results into a sell position, and assignment of a short put results into a buy position. So for example, suppose I have a call option on Reliance with a strike price of 1,200. Okay, and the option was to expire in January. And let's say on the expiry date, the Reliance stock was had closed at 1,250. Now, because this is a call option and the closing price is higher than the strike price, my option is in the money. Okay, and because my call option is in the money, then I am required to buy the underlying shares. So let's say the contract size is 500, and let's say I have bought one call option contract. That means now on the expiry date, because my option has expired in the money, I will be required to take delivery of the 500 shares by paying the strike price. So what is the strike price? 1,200. So I need to pay an amount of 1,200 multiplied by 500. Okay, I have the obligation to pay this amount 1 day after the expiry, and in turn I will receive shares, 500 shares of Reliance. Okay, and the option is in the money, right? So it will be assigned to somebody else who had a short position in the same option. So basically the call seller, the person who sold me this call option, he has the obligation to deliver 500 shares of Reliance to me, and he will receive this amount. Okay, so this is how the exercise takes place in case of in the case of options. Similarly, if I were holding a put option, suppose I had bought a put option on ITC with the strike price of say 450. Okay, and on the expiry date the stock closed at 400. Now remember, this is a put option and my strike price of 450 is higher than the closing price of 400. So my put option is in the money. Okay, that means I will be required on T+1 day, that is 1 day after the expiry, I will be required to deliver the underlying shares, whatever is the contract size. Suppose the contract size is 200, then I'll be required to deliver 200 shares of ITC, and in turn I will receive the strike price of 450. So I will receive an amount of 450 times 200, and I'll be required to deliver 200 shares. Okay, and the person who sold me this put option, right? My in the money position will be assigned to the put seller. What is the obligation of the put seller? The put seller will have to receive these 200 shares from me, and he will have to pay me 450 times 200, that amount. Okay, so this is how the exercise, this whole process is known as exercise and assignment. That is when the option buyer exercises his option, that position is assigned to the option seller. Okay, so exercise and assignment happens, and then the settlement happens 1 day after the expiry date. Okay, and now this facility of net settlement of cash segment and F&O on expiry, this has been allowed. Okay, so now what this means basically is basically what it says is that under the net settlement mechanism on expiry of F&O positions, a client's obligations arising out of cash segment settlement and physical settlement of F&O can be settled on a net basis. Now, what does this mean? It means that basically, let us say on the expiry date, let's say I have a short position in uh, Reliance Futures. Okay, I have a short position in Reliance Futures, and let us say my position is open on the expiry date. Now, because this is a short position, it means I am obligated to deliver the Reliance shares on T plus 1. And let's say on the expiry date, I have bought shares of Reliance in the cash segment. Okay, now remember, I have bought shares on the expiry date. The settlement of this will also happen on T plus 1, and I have my short futures position open on the expiry date. This settlement will also happen on T plus 1. So I have a short position in the F&O segment and I have a long position in the cash segment. Both these positions will be netted out on T plus 1. Okay, so netting out is possible. So now what is the condition? Netting out is possible only for investors who trade and clear through the same TM-CM combination in the cash and F&O segments. So I'll be allowed to net off my trades in F&O and cash only if I am trading through the same combination of trading member, clearing member in both the segments. Investors whose TM clears trades through different CM cannot avail the benefit of netting. And likewise, the benefit of net settlement is not available to institutional investors. So this benefit is available only to retail investors, not to institutional investors. Who are the institutional investors? So typically mutual funds, banks, pension funds, okay, insurance companies, these are institutional investors, FIIs. So they are not allowed to do this netting off. It's only the retail investors who are allowed this facility of netting off. Now, so we looked at clearing and settlement. Now let's look at the risk management. Okay. So exchanges with the help of clearing corporations manage the risk in the derivative segment. And what are the main features of the risk containment measures? So basically exchanges have very, very strict requirements of capital adequacy for membership. So who can be a member of the exchange? So we earlier said that clearing members need to have a minimum net worth of 3 crore, etc. Right? Why do we have all these requirements? To ensure that the members or the brokers are financially strong. So there are capital adequacy requirements. The second is the margin requirements. So clearing corporation charges upfront margins for all the open positions of a clearing member. And these initial margins are, specified on a daily basis. And lastly, open positions are settled on a mark-to-market basis for each contract. So we saw in the case of futures contracts, there is continuous settlement. Okay, settlement happens on a daily, ongoing basis as long as the position is open. So these are the main features of the risk management system. So clearing corporation has an online position monitoring system. So it can monitor the positions of all the brokers and all their clients on a real-time basis. And it monitors them for initial margin, exposure margin violation, while TMs are monitored for initial margin violation. So basically, for all the open positions, as soon as an order is executed, the clearing corporation charges upfront margin on these orders. Okay, initial margin and exposure margin. And then as long as the position is open, it keeps on revising the margins on these positions. And this margin is compared with the collateral or the funds which the broker has placed with the clearing corporation. And as soon as the margin, the amount of the margin exceeds the collateral, okay, placed by the broker, the clearing corporation asks the broker to bring in additional margin. That is, it makes a margin call. Okay. And if the broker is not able to provide this additional margin, then action is taken against the broker. Okay, so basically clearing corporation continuously monitors the open positions of all the brokers and keeps on calculating the margins on these open positions and compares the margins with the available collateral of the broker to find whether the collateral is sufficient to meet the margin requirement. Okay, now how is this margin calculated? There is there is a system known as SPAN. Okay, SPAN stands for Standard Portfolio Analysis of Risk, and the margins are calculated according to this system. Okay, so how are these margins calculated? We will have a look at it later. So Let's look at a few questions. Mark-to-market margins are collected on a weekly basis, every 2 days, every 3 days, on a daily basis. What is the correct answer? Any guesses? Well, the correct answer is they are collected on a daily basis. Remember, we said that mark-to-market happens on a daily basis for futures, right? We'll take one more question. Margins in futures trading are to be paid only by the buyer, only the seller, both buyer and seller, or by the clearing corporation. What is the correct answer? So the correct answer is they are paid by both buyer and seller. Okay. So, okay. So that was the first part of the clearing and settlement. Now let me look at the second part, or rather that was the second part. Okay, I hope the screen is visible. So a while ago, I talked about this system for calculating margins. It is known as PAN. It is a risk management margining software. It was originally designed by Chicago Mercantile Exchange, and it has been licensed to Indian exchanges. So this software is used for calculating the margins on derivative positions on a real-time basis. Now, basic objective of SPAN is to determine the largest possible loss that the portfolio may suffer from one day to the next. Okay, so basically what happens under SPAN is that the exchange looks at different scenarios. Okay, basically exchange looks at 16 different scenarios. So suppose I have taken a long position in say, let's say I have bought a call option on a particular stock. Okay, I have bought a call option, right? Now, what can affect the price of this call option? There are two main things which can affect, right? First, the changes in the stock price. So, because I have bought a call option, if the stock price increases, my option premium will also increase and I'll make a profit. But if the stock price decreases, then the option premium will reduce and I'll make a loss. Correct? So the stock price is one very important factor, and the other factor is the volatility of the stock price. So if the stock price volatility increases, then my option premium will increase and I'll make a profit. But if the underlying volatility decreases, then the option premium will fall and I'll make a loss. Okay, so two important factors, the underlying price and the underlying volatility. So what the exchange does under SPAN, in the SPAN system, it looks at 16 different scenarios. Okay, so what if the stock price rises by 1/3? Okay, and the volatility also rises. What if the stock price falls by 1/3 and volatility rises? Okay, so it looks at different scenarios of changes in the underlying price and changes in the volatility. And for each scenario, it calculates what will be the revised option premium. And then it compares the revised option premium under that scenario with the current option premium and calculates what will be the gain or loss. And this is done for each of the 16 scenarios. And of all these scenarios, the scenario where the loss is maximum, okay, it identifies under which scenario the loss will be maximum, and the amount of this maximum loss is collected as margin. So basically, it says that which is the most unfavorable scenario that can happen over the next one day, and what will be the maximum loss under this most unfavorable scenario, and that amount is collected as SPAN margin from that client, okay, from that trader. Okay, so this is known as the SPAN margin, right? So this is how the SPAN margin is calculated, and the SPAN margin is part of the initial margin which is collected by the exchange. Okay, the other part of the this thing along with the initial margin, it also collects premium. So we know that whenever we buy an option, we are required to pay premium, right? So this premium is also collected by the exchange, this thing, and this is also part of the initial the margin. Okay, so this amount is also blocked. And then there is something called assignment margin. So what is this assignment? So initial margin is collected at the very moment the order is executed, right? Payment for the premium is done on T plus 1 day. We already saw, right? The premium settlement happens on T plus 1 day. Now, what is assignment margin? So the moment so you know that whenever the option buyer, okay, his position is in the money, then that position will be assigned to the seller of that option, right? So whenever the exchange feels, right, as the contract is approaching the expiry, and the exchange will calculate what is the probability that on the expiry date this option will expire in the money, okay, and then from uh, even before the actual expiry date, exchange starts collecting assignment margin from the seller of that option. Okay, so how is this calculated? Okay, so somewhere, so assignment margin is basically levied on the clearing member whose client is holding a short position in the option, and that option has been assigned. So assignment margin is the net exercise settlement value payable by the clearing member towards final exercise settlement. Okay, so on expiry date, exchange has calculated which of the options are in the money, and those options are assigned to the option seller. And on the expiry date, the amount equal to the difference between the closing price of the underlying and the strike price of the option, that amount is blocked from that clearing member by way of assignment margin. And on the next day, that is 1 day after the expiry, after the actual settlement has taken place, the assignment margin will be released. Okay. Now, what are delivery margins? So delivery margins, again, they are part of initial margin, and they are levied on the potential deliverable positions or in the money long option positions 4 days prior to expiry of the derivative contract, which are to be settled through delivery. Okay, so let's look at an example. So basically, delivery margins are levied and collected from the member in a staggered manner. So let's say expiry is 4 days away. Then on 4 days prior to the expiry, the exchange will look at all the open positions in options, and it will try to decide how probable it is that that option will expire in the money on the expiry date. Okay, so basically 20% delivery margin will be levied, okay, 4 days prior to expiry, okay, and 40% will be levied 3 days prior to expiry, 60% will be levied 2 days prior to expiry, and 80% will be levied 1 day prior to expiry. Okay, so what is the purpose here? The purpose is to ensure that, so why does the exchange do this? Why does it start levying these delivery margins 4 days prior to expiry? Because it wants to make sure that only only investors who are actually interested in taking delivery or giving delivery, only they remain in the market. Okay, because the moment it starts levying delivery margins, then investors who are not actually interested in taking delivery, they will start squaring up their positions, right? So to make sure that only genuinely interested parties are left in the market till the expiry date, it starts levying these delivery margins so that people who are only taking speculative positions, okay, they will naturally exit because they would not like to pay these higher margins, right? So they will exit, and only genuinely interested people will remain in the market for taking and giving delivery. Okay, so gradually it scales up the delivery margins as we approach the expiry date. And again, once the settlement has taken place, so settlement, as we said, happens 1 day after the expiry. Once the settlement takes place, that is, the stock has been delivered and the amount has been paid, the delivery margins will be released. Okay, so exposure margin. So exposure margin is something in addition to the initial margin. Okay, so initial margin is charged by the exchange to cover the 99% value at risk for that particular stock. That is what is this 99% confidence value at risk? So it is basically the loss, the maximum loss which can be suffered in one day at a 99% confidence level. Okay, so there is this statistical concept called value at risk, which is applied by the exchange for. So the initial margin or the span margin is based on this 99% value at risk calculation. But again, we said that it is the loss which can be sustained over 99 days out of 100, right? But what happens if there is some extremely abnormal price movement on a particular day? Okay, something like some black swan event happens, then on such a day the actual loss can be much higher than this 99% var, right? So to take care of these abnormal situations, the exchange also charges something known as the exposure margin. Okay, so exposure margin is in addition to the initial margin, and that is collected from the clearing members. Okay, now in case of futures, we saw that there is something called daily mark-to-market settlement, which happens every day. So every day the open positions are mark-to-market at that settlement, that day's settlement price, and the next day the person with the loss, mark-to-market loss, has to make the payment to the exchange, and exchange will transfer that amount to the client with the mark-to-market profit. So there is an explicit pay in and payout which happens in case of futures contracts. But in case of option contracts, there is no explicit daily mark-to-market payment that happens, right? But what happens is that every day the exchange will look at the net option value of the client. Okay, so suppose there is a client who has bought and sold options of a particular contract. Okay, so exchange will look at so for all options that he has bought. Okay, exchange will look at what is their current price, and for all options that he has sold, again exchange will look at their current price. So basically net option value tells you what is the value of his long positions minus the value of his short positions, and if this amount is positive, that means there is a mark to market gain, okay, for that client. So this mark to market gain will be added to the liquid net worth of the member. And if there's a mark to market loss, that is if the net option value is negative, then this amount will be deducted from the liquid net worth of the member. So there is no explicit settlement of mark to market in case of options, but the mark to market gain or loss is simply added or subtracted from the liquid net worth of the member. Okay, and then what is this client margin reporting? So clearing corporation, it at the end of the day, it informs all the brokers of the margin liability of each client, and members are required to in turn, members are required to collect margins from their client and report them to the exchange. Okay, and suppose the margin requirement is say 100 rupees, and let's say the member has collected only 80 rupees from the client by way of collateral, then 20 rupees is short collection, right? So members are penalized. The exchange, the clearing corporation levies a penalty on the members for short collection or non-collection of margins. Okay, so in the interest of time, I will skip this. Let's come to early paying of securities and funds. So basically, the exchange, normally the paying has to be made, let's say, on say T+1 day, right? So all positions in equity derivatives are settled on T+1. Okay, so if the client has bought a future whatever contract, okay, this thing, then delivery has to be made on the next day, right? But sometimes the client can make early paying of securities or early paying of funds, and in that case, the early paying means any paying of securities which is made before the official time of settlement, right? So if early paying is made, then those positions are exempt from delivery margins. Okay, so that is the advantage. And what is this mechanism for pledge repledge of client securities? So earlier, what used to happen is that when a uh, clients used to provide a power of attorney to their broker to enable the broker to transfer securities from the client's demat account to their collateral account for the purpose of meeting the client's margin obligation. So you know that exchange, the clearing corporation levies a margin on all brokers, and brokers in turn collect that margin from their clients. Now clients are free to give securities to their brokers by way of collateral. And earlier clients used to give a power of attorney to the broker that whenever the margin requirement goes up, the broker could take the securities from their client's demat account and deposit them as margin with the exchange. But there have been cases where brokers have misused this power of attorney and they have misappropriated securities from the client's demat account. So to prevent this kind of misappropriation, the uh, brokers, what the exchange has done is that it has introduced a pledge repledge mechanism which came into force from September 2020. Okay, so now under this pledge repledge mechanism, the clients can provide collateral only through a margin pledge and not simply by executing power of attorney in favor of the broker. So in their depositories, they will record. So basically, if I have say 10 securities in my demat account, I can mark two of them as margin pledge. Okay, and these two securities will be marked by the depository as pledge for margin. And uh, so basically, I am not giving any power of attorney to the broker. So broker cannot, on his own, he cannot take these securities from my account and use it for anything else. Rather, I create a pledge. The securities remain in my demat account, but I have created a pledge on them in favor of the broker. Okay. So this is much safer than giving up power of attorney to the broker. And so the broker must open a separate demat account for accepting the margin pledge of the client, and this demat account is tagged as client securities margin pledge account. Okay, so the name of the account also indicates that these are securities which are kept by the client for margin pledge. Okay, so in this way, the SEBI has made it, uh, you know, made it much safer for the clients who are, giving their securities to the broker by way of margin, because now the securities will be held in a separate account called client securities margin pledge account, and there is a clear, demarcation between the other securities held by the broker and the client securities which are held as pledge. Segregation and monitoring of collateral at client level. So this is again a new system which has been brought about by SEBI, again to make sure that the collateral which is received from clients is kept separate from the broker's own funds. Okay, so the trading member has to report to the clearing member the client collateral received from individual clients, the client collateral retained by the TM, and the client collateral placed by the TM with the CM. And similarly, the clearing member has to give information to the clearing corporation. So what is the collateral received by the TM from individual clients? What is the collateral retained by the TM? How much is the collateral placed by the TM with the CM? Okay, how much is retained by the CM and how much of the collateral is placed by the CM with the CC? So all this reporting is required on a daily basis. So in this way, the exchange has a clear idea of how much collateral has been collected by the trading member and the clearing member, how much collateral is retained with them, and how much has been placed with the clearing corporation. Okay, so by implementing all these things, by the implementing that margin pledge repledge of margin and segregation of collateral at client level, SEBI has taken a number of steps to make it safer for clients to you know, deal with their clearing members, and to make sure that there is no appropriation of collateral by the broker, and basically to make it very trading, make it safer for the clients to continue their trading. Okay, so that's the third module, and let me just do the final module of clearing and settlement. Okay, so in the earlier module, we looked at how the exchange collects different margins from the members, and now let's look at something called position limits. So again, position limits are imposed by SEBI at three different levels: client-wise, client-level position limit, wide position limit. So why are position limits necessary in derivatives market? Is because the derivatives are not actual assets, right? They are contracts which are written on the underlying stocks. So if there are no position limits, then it can happen that the number of derivative contracts may be higher than the number of shares which are actually available for delivery. So this should not happen, right? And therefore exchange the SEBI has announced position limits at different levels. Okay, so first is the position limit at the client level. So for each individual client, the position limit, the gross open position across all derivative contracts for a given security should not exceed 1% of the free float market cap or 5% of the open interest in all derivatives on the same stock, whichever is higher. Okay, and so this is the client level position limit. And likewise for individual members, trading members, there are limits for how much position they can hold in index futures and index options. And finally, there is a market-wide position limit, which means is which is fixed at 20% of the number of shares held by non-promoters. So basically, if a company has issued say 1,000 shares, just to give an example, then 20% of this 1,000, right? So 200 shares will be the market-wide position limit for that security, which means that the open interest of all futures and options contract for that security cannot exceed 200. Okay. Now, what the exchange does is, moment 95% of the limit is reached, the exchange announces a ban on further positions. So, if the market-wide position limit is 200, okay, 95% of that will be 190. So, if the open interest of all futures and options on that stock crosses 190, or rather reaches 190, then exchange will say that you cannot take further position in futures and options for this particular stock. Okay, so clients are allowed to close their existing positions, but they are not allowed to take fresh positions. So that is the market wide position limit. Now, if any of these position limits are violated, then there are a number of consequences. So there are penalties. Okay, so penalties are levied for non-fulfillment of initial margin obligations, non-fulfillment of settlement obligations. Okay, violation of position limits and etc. Okay, so okay, what is the settlement guarantee fund and investor protection fund? So for every exchange, okay, it is mandatory for the exchange to have a settlement guarantee fund. Clearing corporations must have a core settlement guarantee fund, and the objective is that to guarantee the settlement of trades. So suppose there is a default by one of the parties to the trade, then we said that the clearing corporation will have to step in, and it will have to make either make the payment on behalf of the buyer or deliver the security on behalf of the seller. Now obviously this has a cost. So every time if the clearing corporation has to do the settlement, then it will incur a cost. So from where, how can it, pay this amount? So this amount is taken from the settlement guarantee fund. So every clearing corporation has to have a core settlement guarantee fund, which is used for, meeting its obligations in case there is a default. And in addition to that, exchanges have to maintain an investor protection fund. And the objective of this is to compensate investors in the event of defaulting members' assets not being sufficient. So suppose a particular member has defaulted, broker has defaulted, okay, and exchange will use all his assets, securities, okay, his collateral, everything will be used for meeting his obligations. And in spite of that, suppose his collateral is not enough to meet all the obligations of his clients, then exchange will dip into the investor protection fund and use it to compensate the investors. And of course, this fund is also used for investor education, awareness, and research. Okay, so that is about the clearing and settlement. Okay, so before we go further now, next I'll be covering the legal and regulatory environment. Okay, so what is the legal and regulatory environment for the derivatives market? So trading of derivatives is governed by the Securities Contract Regulation Act 1956, okay, and the SEBI Act 1992. Now, under the Securities Contract Regulation Act, uh, the term securities was defined to include, so there is an inclusive definition of the term securities. So securities includes shares, scrips, stocks, bonds, debentures, or okay, or other marketable securities of any incorporated company, and it also includes derivatives. It includes units of mutual funds. So it includes several things. Okay, so stocks, bonds, debentures, units of mutual fund, okay, units, government securities, rights or interest in securities. The interesting thing was that earlier the definition of securities did not include the term derivative instruments. Okay, it was only when the government decided to permit trading of derivatives on Indian exchanges, only then the government amended the Securities Contract Regulation Act, and the term derivatives was included in the definition of securities. Okay, so now the term securities also includes derivative instruments. Okay, so so that is the Securities Contract Regulation Act. It defines what are securities, and that term includes derivatives. And the SEBI Act, okay, under the SEBI Act, SEBI has specified the functions of the Act has specified the functions of SEBI, and what are the main functions of SEBI: to protect the interest of investors in securities, to promote the development of the securities market, and to regulate the securities market. Okay, and the jurisdiction of SEBI extends to all intermediaries in the security market. So who are the intermediaries in the security market? So basically all the brokers, okay, all the brokers, then all the investment bankers, okay, then the underwriters to the issue, the registrar and share transfer agents, the depositories, depository participants, these are all the intermediaries in the securities market. So SEBI has jurisdiction over all the market intermediaries, and it also has jurisdiction over all the companies who issue capital and who issue securities, right? So all these are under the jurisdiction of SEBI. Okay. Uh, Now, mm, so as we said earlier, all the brokers, okay, all brokers who want to be members of a particular exchange, they have to seek register. They have to be registered with SEBI. Okay, so the minimum net worth, we said earlier that for the clearing members, okay, brokers who want to be clearing members of the clearing corporation should have a minimum net worth of 3 crore. And according to SEBI, this net worth means, what does the term net worth include? Net worth includes the capital plus free reserves of the broker minus all non-allowable assets like fixed assets, pledged securities, members card, non-allowable securities, okay, doubtful debts, prepaid expenses, intangible assets. All these are to be excluded. So basically, capital plus free reserves of the broker minus the non-allowable assets, that is the net worth of the broker. And this has to be minimum 3 crore if the broker wants to be a clearing member of the clearing corporation. Okay. Similarly, SEBI has also specified that the minimum value of each futures and options contract should be rupees 5 lakh. Okay, and initial margin and exposure margin requirements have also been specified by SEBI. Okay. Okay, so what are the responsibilities of the clearing corporation? We said that clearing corporation is responsible for collection of margins, for ensuring daily clearing and settlement. It has to act as the central counterparty or legal counterparty for each contract, monitor the positions in the derivatives and cash segment, decide the daily settlement price, and maintain record of margins at the client level and ensure that client margins are not appropriated by the broker. Okay, and it has to submit certain reports to the exchange, to the SEBI, and it has to maintain a trade guarantee fund, which we saw earlier, that the aim is to make sure that all contracts are settled. Even if there is a default by one of the counterparties, the clearing corporation can use the trade guarantee fund or the settlement guarantee fund to cover the default and to ensure that the trade is settled. Okay. Now, again, what are the eligibility criteria? So first, to be a member of any segment of the derivative segment, the net worth requirement has to be fulfilled, which is 3 crores for clearing members and 1 crore for self-clearing member. And this net worth must at least 50 lakhs must be maintained as liquid net worth. Liquid net worth means the net worth, this 50 lakhs should be in the form of liquid assets. Okay. Liquid assets like cash, bank guarantee, etc. Then okay, so these are the and certification requirements, right? So any brokers who are members of the exchange, right? They have to have at least 2 approved users who have passed the SEBI certification programs. Okay, so certification and continuing professional education, these are very, very important. Now there is what if there is a outage, then or what if there is a default? So SEBI has laid down certain standard operating procedure which has to be fulfilled whenever there is any default by a trading member or clearing member. Similarly, if there is any outage means if there is any technical glitch at any exchange, then how the glitch has to be handled. Okay, that for that also SEBI has laid down a standard operating procedure. Okay, so that is about the legal and regulatory environment. And now we will move on to the final module for today, which is to do with accounting and taxation. Okay, so let me just share my screen. Okay, so basically the accounting of index and stock futures is in accordance with the guidance note which is issued by the Institute of Chartered Accountants of India. And so for futures contracts, basically whenever you take a position, whenever a client takes a long or short position in a futures contract, then initial margin has to be paid, right? Here the client has to pay an initial margin to the broker. So what is the entry passed for this? Entry passed would be initial margin, equity index or equity stock futures account is debited and cash or bank account will be credited. Okay, and on the balance sheet date, the balance in this initial margin account will be shown separately under the head current assets. Okay, so simple. Initial margin account is debited, bank account is credited, and this amount is shown under current assets. Now, what about mark to market? So we know that in the case of a futures contract, there is daily mark to market that happens. So mark to market margin has to be paid if there is a loss, and if there is a mark to market gain, then mark to market margin account will be received. Okay, so again, entry passed would be debit mark to market margin account and credit the bank account when there is a payment. And if there is a mark to market profit, then entry passed would be bank account debit and deposit for mark to market margin account will be credited. And again, the balance will be shown under current assets. If there is a debit balance, it will be shown under current assets. Now, if there is suppose the client is consistently losing money on the futures position, okay, so every day he has a mark to market loss and he is continuously paying, okay, then keeping in view the prudence principle, there a provision must be created, okay, because if 3 days in a row suppose he has a mark to market loss, that means it's very likely that his position will expire in loss, right? So he has to create a provision for this amount, and this amount, so in the balance sheet, the balance in the mark to market margin will be shown as a under the head current assets, and from this the provision which has been created will be reduced, Okay, so net amount will be shown under mark to market margin account. But suppose every day he has a mark to market gain. Okay, so suppose he's in a winning position and every day he has a mark to market gain, right? So again, this gain should not be recognized because this is an unrealized gain, right? This is an unrealized gain. So according to the principle of prudence, we do not take into account unrealized gains, right? So no entry should be passed for the unrealized gain. But if there is an unrealized loss, then provision has to be created. Okay. Now, at the time of squaring up, okay, so on the expiry date, at the time of final settlement, the the difference between final settlement price and contract prices of all contracts should be taken into account, and this profit or loss should be recognized in the P&L account by corresponding debit or credit to market margin account. Okay, and same entry is passed when the contract is squared up. That is, the position is not held till the expiry, but it is squared up. Same entry will be passed. Okay, so difference between the settlement price and the contract price of all contracts, that is recognized in the profit and loss account. Now, what happens if there is a default? Okay, so if there is a default, the contract is closed out. So if the client makes any default in payment of daily settlement, daily mark to market, suppose he doesn't pay the mark to market margin, then the broker will close out the client's position, and the amount not paid by the client is adjusted against the initial margin. And if there is any excess margin remaining, it will be released. But if there is any shortfall, then client will have to pay the shortfall. Okay. Now, what about options? So accounting for cash settled options. So the seller of the option is required to pay an initial margin for selling the option. Remember, in an option contract, the option seller has to pay the margin, but the option buyer only pays the premium. So for accounting for the initial margin, again, the equity stock option margin account is debited and bank account will be credited, and this margin account will be shown under the head current assets. And similarly, the buyer pays a premium, right? So again, he will pass the entry or equity option premium account debit and bank account credit, and he will show the premium account under the head current assets. Okay. Now, what about open positions on the balance sheet date? So if suppose I have bought an option, okay, and at the time I bought it, it was worth I bought it for a premium of 50 rupees, and let's say on the balance sheet date the same option is being traded at 40 rupees. That means if I were to square up this option today, I would incur a loss of 10 rupees, right? So I have to make a provision for this loss. Okay, but if the option is trading at 60 rupees, then I have an unrealized gain of 10 rupees, right? So no entry should be passed for the unrealized gain, but provision should be made for the unrealized loss. Okay, so that is how the open position will be treated. And what happens at the time of final settlement? So the buyer or the holder will recognize the premium as an expense in the profit and loss account. So when the final settlement happens, the premium will be, so remember this premium was earlier being shown under the head current assets. Now it will be transferred to the profit and loss account as an expense. And on exercise of the option, the buyer will receive the favorable difference between final settlement price and strike price, which will be recognized as income. Okay, so if the option has expired in the money, then the buyer will receive the difference between the strike price and the closing price of the underlying, and this will be treated as an income. In the seller's books, the premium will be recognized as an income, and if the option has been exercised, then the seller will have to pay the difference, right? The adverse difference, and this will be recognized as a loss. Okay. So what about, so that was in case of options which are settled in cash. What about options which are settled by delivery, by physical delivery? Okay. So at the time of final settlement, if the option is exercised, then shares will be transferred in consideration for cash and the strike price, and accounting treatment will be So if it is a buyer, okay, if it suppose somebody has bought a call option and that option has expired in the money, then the call buyer will receive delivery of the shares, right? So security account will be debited and he will be paying the strike price, so bank account will be credited, right? And if a put option has expired in the money, then the put buyer will receive the strike price, so bank account will be debited and security account will be credited, and reverse entries will be passed in the books of the seller. Okay, so that's about the accounting of derivative transactions. And the last part, we will look at the taxation. So how is the derivatives income taxed? So income from trading of derivatives. So in India, income from trading of derivatives is charged under the head profits and gains of business or profession. And such income is treated as non-speculative income. Okay, so any income from trading of derivatives is treated as non-speculative income, which is a good thing, because any loss from trading of derivatives, because it is a non-speculative loss, it can be set off against any other income except salary income. Okay, had it been treated had it been treated as a speculative loss, then it could have been set off only against speculative income. But because it is treated as a non-speculative income, it can be set off against income in under any other head except salaries. And suppose the loss cannot be set off against income under any other head for that year, then that loss can be carried forward for the next 8 assessment years, and it can be set off against any other non-speculative income in the next 8 assessment years. Okay, so carry forward of loss is allowed. So during a particular year, the loss from trading can be set off against any other non-speculative income except salaries, and if it cannot be set off in that year, it can be carried forward to the next 8 assessment years. Okay, but the right to carry forward is allowed only if the return of income has been filed before the due date. Okay, so that is about the carry forward. Then for foreign portfolio investors, the gains or losses from derivatives are taxable under the head capital gains, right? So for Indian investors, for domestic investors, the trading income is to be charged under the head profits and gains from business or profession, but for foreign investors, they are to be taxable under the head capital gains. Okay, and again, presumptive scheme of taxation is also available. So basically, if you are a trader of derivatives, right, the ideally you should be maintaining all books of account, okay, maintaining a record of all your transactions, and if your turnover is beyond a particular level total, then you may also require to get your books audited. Okay, but Income Tax Act allows a presumptive scheme of taxation under section 44 AD. So if your total turnover does not exceed 2 crore, then you can go for this presumptive scheme of taxation, and under this the gains are a flat amount of 6% of your turnover is treated as your gain. So you don't have to maintain a specific record of all your transactions and everything and actually calculate the gain or loss. Your income is treated, taken at a flat rate of 6% of your turnover, and you have to pay tax on that. Okay, so there is no need to maintain books of account or get your books audited. So that is about the filing of the return of income. And finally, that, STT, the Securities Transaction Tax, is levied on every purchase and sale of securities. And it is for listed, securities which are listed and traded on the exchanges. Okay. So what is the rate that we have already seen in an earlier slide for option, sale of options? Seller has to pay the STT, and that is calculated on the premium. And for exercise options, buyer has to pay the STT, and that is levied on the settlement price. And for futures, again, the seller has to pay the STT, which is at a, so different rates have been prescribed for different transactions. Okay, so that is about the STT. Okay, so that is all about the taxation part. And with that, I have come to an end of today's module. So in today's module, we covered the trading mechanism, the clearing and settlement of equity derivatives, the legal and regulatory environment, and the accounting and taxation requirements. Okay, so with that, I have reached the end, and if there are any questions, I'll be happy to take any questions.
Anybody has any question? You can put it in the chat. I will allow you to speak. Or you can just raise your hand. I will allow you to speak. Anybody has any question? Aman Gupta, Bishman Kaur, Unnati, Priya, Kumari, Sakshi, Neha, Sahil, Nishant, Gaurav, Akshit, Aditya, Nitin, Rahul, Hitesh, Jatin, Priya, Dishant. I think nobody has any question, ma'am.
Yeah. Okay.
So thank
So
you so much, ma'am, for
yeah.
taking this lecture. And we'll have more session in the future with these students. And Aparna ma'am will be there for most of the sessions. So thank you so much, dear participants. We'll meet in some other student development program on another topic. We'll share the feedback form as well as PPTs. You can go through the PPTs and give us your feedback form as well as suggestions. What kind of sessions do you want in the future? Thank you,
Okay.
ma'am.
Okay. Thank you, Ashutosh, for giving me this opportunity. Nice to be here.
So with your permission, I would like to conclude the session, ma'am.
Yes, please.
Yeah, Team IT, please close the recording and close the session.